I will be trying to go over what I consider to be some of the most important metrics and elements when it comes down to successfully manage a real estate private credit fund. And of course, I'm going to talk a little bit about RBI's approach towards next year, considering all macroeconomic conditions. So the first thing to consider is that RBI Lending Fund's mission is very well oriented towards two main objectives, and those are, of course, capital preservation and steady returns. And here I might say that, the reason why both individual and institutional type of investors have widely accepted this type of asset within their portfolio is precisely because they help them hedge against volatility, hedge against inflation, while earning returns that are substantially higher than they would otherwise obtain from traditional fixed income instruments. RBI follow a very strict mandate when it comes on where and how to invest. And for those of you who do not know us, our portfolios are composed of seniorly unsecured loans. We only advance up to 65% of the appraised value. We only take real estate as collateral, and typically we do very short term, between 12 and 24 months. Next slide, please. So as I just mentioned, our maximum loan to value would be 65%, although our actual numbers for the month of October talked about 49.27%. And that, of course, mean that our collateral was 2 times or double the size of our current loan portfolio. Another key element to our strategy as balance sheet lender would be, of course, the short-term nature of the underlying asset. Please note that our average term is more 14.6 months. That's relatively short, and that, of course, gives us great advantages when it comes to liquidity and being able to reassess our risk constantly, as we might always be asking ourselves to what type of assets do we want to be more exposed, what geographical areas do we think are going to behave more stable over the course of the foreseeable future, what metrics do we want to incorporate as part of our underwriting procedures. And as you can see here in this yellow line, that pretty well denotes how much of our portfolio would come to maturity. You would see that within 12 months, near to 80% of our portfolio would have already come to maturity. A very important shift we have seen in the industry is this change from fixed interest rate to variable interest rate contracts, and that, of course, it's very beneficial for us as fund advisors and for our investors, as well as we mitigate the risk of being underperforming with all of these interest rate variations we have seen in the past couple of months. As a fund, we have been able to deliver to our investors over a 9% yield in the past 2 years. That's a 9.56% for this type of asset. And of course, another thing that is very core to our strategy is being able to access a very robust source of deals. As I just mentioned, our very short-term underlying asset makes us having to be constantly reinvesting all of those cash proceeds, and for that we need to have the deals that better align or better fit into our strategy at any given moment. We would see that RBI is in management with more than 500 million in loan originations, no capital losses till date, and more than 80 million in assets under management as of November 2022. And of course, we have a medium-sized management which very well enables us to have more involvements with credit decisions. Our source of deals, of course, includes real estate agents to whom we've developed relationship over the course of 6 years, mortgage brokers, search engine optimization, investments, and other digital marketing as well.